Ever felt like you're on an economic roller coaster, unsure of when the next twist or turn will come? This week is already promising to be a whirlwind in the world of finance, with the Federal Reserve making critical decisions on interest rates, fresh data on inflation, and more. As we dive into these financial currents, let's start with a chuckle. What do you call an illegally parked frog? Toad. Investing is like operating an MRI machine. Precision is key. But don't get too relaxed, because this week, the market could throw you for a loop like a cat playing with a laser pointer. Stay sharp, and remember, dogs can't operate MRI machines, but cats can. Now let's break down the week's financial events, their implications, and what they mean for your wallet. Unchanged rates amid economic uncertainty. The Federal Reserve, the central bank of the United States, decided to keep interest rates steady this week. The federal funds rate remains in the range of 5.25% to 5.5%, a level reached after a series of 11 rate hikes between March 2022 and July 2023. This decision leaves many wondering about the future trajectory of the economy. Why this matters. Higher interest rates influence various aspects of the economy. When borrowing costs rise, both consumers and businesses tend to reduce spending. This can lead to decreased productivity and earnings for companies, putting downward pressure on stock prices. Investors might then prefer safer options like bonds or high-yield savings accounts over stocks. Impact on mortgages. While the federal funds rate doesn't directly set mortgage rates, changes in this rate can impact treasury bonds and the broader bond market. This, in turn, affects mortgage rates. As rates rise, borrowing costs for homebuyers increase, potentially cooling the housing market. Consumer Price Index, CPI report. Last week, the Consumer Price Index, CPI report, provided a glimmer of hope. The CPI increased by 3.3% year-over-year in May, slightly below the expected 3.4%. While this indicates that inflation is cooling, the rising costs of housing continue to strain consumers. The bigger picture. Inflation affects every aspect of daily life, from groceries to gas. Lower than expected inflation rates can ease the financial burden on consumers, making goods and services more affordable. However, persistent high costs in essential sectors like housing and healthcare remain a challenge. Producer Price Index, PPI, report. Adding to the positive news, the Producer Price Index, PPI, declined by 0.2% in May, contrary to expectations of a 0.1% increase. This marks the second significant inflation reading this week, showing progress in controlling rising prices. What this means. A lower PPI suggests that the costs of goods at the wholesale level are decreasing, which can eventually lead to lower prices for consumers. This is a crucial step towards stabilizing the economy and reducing overall inflation. Maximizing savings in a high-interest environment. With interest rates at their highest in over 2 decades, there's a silver lining for savers. High-yield savings accounts are offering up to 5.25% interest, turning your savings into a powerful tool for wealth growth. How to benefit. Higher interest rates mean more significant returns on savings. By choosing a bank that offers a high-yield savings account, you can earn substantial interest on your deposits, giving you more financial flexibility and the ability to grow your wealth with minimal effort. Rising jobless claims. The labor market showed signs of strain, with first-time claims for jobless benefits increasing to 242,000 for the week ending June 8th. This marks the highest level since August 2023, indicating potential challenges ahead for the job market. Understanding the impact. An increase in unemployment claims can signal economic distress as more individuals seek financial assistance. Monitoring these trends helps gauge the health of the job market and predict potential economic slowdowns. Five Below's struggles. Five Below, once a retail success story, faced significant challenges, with its share prices hitting a 1-year low. The company's troubles stem from rising inflation, supply shortages, and increased competition from online retailers like Temu. Key takeaways. Retailers like Five Below are barometers for consumer spending and economic health. Their struggles highlight the broader impacts of inflation and market competition on traditional retail businesses. Entertainment trends. Hub Entertainment Research revealed that YouTube products dominate the must-have entertainment sources list. This shift reflects changing consumer preferences and the growing influence of digital platforms. The digital shift. The increased revenue from YouTube ads showcases the growing power of digital media. For investors and marketers, understanding these trends is crucial for capitalizing on shifting consumer behaviors. As we navigate these financial waves, it's clear that understanding economic trends is essential for making informed decisions. From interest rates to inflation, each factor plays a role in shaping the economic landscape and our daily lives. Stay ahead of the curve by subscribing to our updates. Like and share this article to help others stay informed. For more insights and tips, join us again next time on our Money Matters Today YouTube channel. Together, we can navigate the economic tides and make the most of our financial opportunities. If you found this video helpful, make sure to like, share, and subscribe for more in-depth analysis and updates on the economy, stocks, and personal finance. Follow us on social media for real-time updates and join our community of informed readers.